This is the 1 minute scalping strategy that works on any markets. Now, the reason this works on any markets is because it is solely based on price action. Price action happens on any markets, any time frames, any pairs, and that is exactly what this strategy is based on. It's a rule-based strategy and one that we can just rinse and repeat over and over again in order to keep our trading nice and simple and to stay profitable. So let's get straight into it. So what I'm going to do is I'm going to explain the strategy whilst looking at some live trades from yesterday. So today is Wednesday the 8th of October, and yesterday there was some good trading opportunities here on GU. We're going to start on GU and then we're also going to look at gold because, like I say, this strategy is applicable across all markets. So all we are looking at here on TradingView is a split screen view of the hourly chart on the left and then the 1 minute chart on the right. I'm sure a lot of you know this by now, but I like to trade using the previous hourly candle, which gives us our direction and our bias. And then the 1 minute chart is when we are looking for entries. So I trade starting at 6 AM UK time. So when I get to the markets, I look here on GU and I can see that we have this bearish candle yesterday at 5 AM. So the 5 AM candle opened here and then closed down here. So 5 till 6, bearish candle, which means that when the new hourly candle opens, so the 6 till 7, we are looking for sells only. Now the reason I like to do this is it just gives us a clear direction on which way to trade, because the 1 minute pattern that we use for our entries does appear often. Now if we're just taking the pattern all day, we haven't really got any directional bias, and in that case we're getting involved in a lot of trades, and then there's potential for over trading, and it just is not as clear as when we know which way we are trading and which patterns we are looking out for based on the previous hourly candle. So like I say, we have this bearish candle close from 5 till 6, which means when the 6 till 7 candle opens, we will be looking for a continuation of that bearish momentum and we will be looking for sells. Now when the 6 o'clock candle did open, I didn't see any entries personally, simply because the pattern that we're looking for didn't actually show up, because we can see that we are just making lower lows and lower highs. Now I'm not necessarily looking for lower lows and lower highs, I am looking for a shift where price starts to push bullish even though we are selling, we then fail and then continue back bearish. So let me show you what I mean. I didn't see any opportunities yesterday from 6 till 7, so waited for the 7 till 8 candle to open, and we can now use the 6 till 7 as our previous hourly candle, so the candle that gives us our bias. It opens here at 6 AM and closes here at 7. Obviously we saw that price action on the 1 minute chart, we didn't get an entry opportunity, price continued down, we do have a bearish candle. Now what happened near the end of the previous hourly candle, so the 6 till 7, is price actually started to push up, and we can see here that we're making lower lows and lower highs all the way through this hourly candle. We then start to make higher highs and higher lows. If we go to the line chart, you'll be able to see it a little bit better, higher highs and higher lows. Now we do actually want to see price do this even though we are looking to sell. The reason for that is we want to give buyers an opportunity to push price up. If you're just taking lower lows and lower highs, then there's potential that buyers haven't really stepped into the market yet, and at any point here, instead of making lower lows and lower highs, we may start shifting to start making higher highs and higher lows. We don't want to be involved in those trades where we get stopped out. We want to give buyers an opportunity to push price up, and we want to see them fail to do so, and that's exactly what happens here near the end of the 6 till 7 candle. We do start to push up, giving buyers an opportunity, and if buyers were stronger than sellers at this point, obviously we'd make this new higher low and then we'd break the previous high, make a new higher low and just continue upwards like that, in which case buyers are in control of that candle and we don't get any entry opportunity. However, we can see that buyers are unable to push price past this point. So they've started to make higher highs and higher lows. They've made the highest point of the candle here. Prices then come down, made a new higher low, and then instead of continuing up, we actually get this shift where price is unable to violate that high. We've made this low, and then instead of breaking the previous high like we do in an uptrend, we actually shift and start pushing bearish. Now once we break this low, we are able to take advantage of this trade. So if we look at it from a line chart perspective, we can see that low a little bit clearer. You do get used to seeing this pattern the more you trade this way, but we can see that that is a low that price has made this high here, came down to make a higher low, pushed up, failed to break the previous high. We've also got these wick rejections, but we don't need to focus too much on that. We just need to see that price is failing to break this high, and if price isn't going to go up, if it's not going to break that high and we don't go sideways, then it has to come down. So once we break this low, that is another sign that sellers are back in control of Great British Pound US dollar during this time, and they are going to continue to push price down because buyers have had a chance to push it up and they just weren't strong enough to do it. We know that we're selling based off the previous hourly candle, and now that the new hourly candle has opened, we look for price to break the low, which it does. Our stop loss would have only been 3 pips, so with this one we could have actually been looking for maybe a 1 to 3 instead of the 1 to 2. I usually go for a 1 to 2, moving stop loss to break even at 1.5. It just depends on how much markets are moving, so I do get questions on why don't I go for a bigger risk to reward. Now sometimes I do, it all depends on what price is doing. If we look at the average range over the past few candles, we can see that this one is 10 pips, this one here is 13 pips, this one here is around 10 pips. So we know that we want to be able to at least double our stop loss in order to try and get in and out of a trade during one hourly candle. So if we've got a stop loss of 3 pips, it is likely that price is going to move at least 6 pips during one hourly candle, provided there is still volume in the markets, which I find at the pre-London session, it's just when people are starting to get into the markets, and I do like the pre-London session. So in UK time, that is the 6 a.m. hourly candle close and the 7 a.m. hourly candle close. I do trade London as well, so London open at 8. So price breaks this low, continues down. Now we can double our stop loss size. Once we enter here, we've got a 3 pip stop loss, so we want price to push at least 6 pips, which we know it has been doing based off the previous hourly candles. So the risk to reward I go for really depends on the size of the stop loss and how much the market is moving at the minute. Should have really gone for a 1 to 3 on this one because I know that price has been moving 9 pips, so I could have tripled this 3 pip stop loss, but either way there is a winning trade. Now one thing that's important to me is the current hourly candle that we are trading is in the same direction as our entry. So obviously we're looking for sells based off the previous hourly candle. So when price breaks this low and I am looking to enter the trade, I do want to see the current hourly candle that we are trading on be bearish, which it is. We can see once we break this low, we'll have a market execution ready to go. When price starts giving us this price action and we come up and fail to break this high, I use this lot size calculator here on TradingView to quickly figure out what size trade I'm taking. Now once I've figured that out, I'm then sat there waiting for price to break the low with a market execution. I like to use market executions as opposed to sell stops or buy stops, simply because what may happen is price may come down, we may have a sell stop order in place. Price may come down to around here, not actually break this low. We get triggered into the trade because of spreads, and then price may just continue up. It might have just been making that pattern to continue making higher highs and higher lows. I don't want to be triggered in by spreads on trades like that. It is easier for me to use market executions, even if it means by the time we have entered, we're a little bit lower. I just prefer to see that clear break of the low before entering the trade. So once we've had that bearish push, a little bit later in the candle, we do get the same pattern. We can see that price starts to make higher highs and higher lows. We get the shift again, so this new lower high. We then break this previous low, which is here. We could have had a 4 pip stop loss this time, so I like to use half and whole numbers. 4, 4.5, 5, 5.5, all the way up to a maximum of 10. And I also use a minimum stop loss of 2. And that would have been a winning trade. Now the reason I wouldn't have taken this one is I like to be part of the first move that happens during the hourly candle. You can see that this one is the start of the new hourly candle, which means that we've got a new hour's worth of momentum coming into that candle. Now as well as that, what I like to see is when price has first made its wick, which it does here at 7 a.m, price opens here and does push up initially. It then fails to continue upwards and flips bearish. I want to find an entry around this area of the candle when price has just started flipping bearish, and then that way we're able to take advantage of the range of the candle. Now with this one, we can see that price does start making higher highs and higher lows, and we do get this pattern again, but by the time we enter the trade, which would have been there, we are really low down on this bearish candle now. So the likelihood of price continuing pushing down after it's already pushed this range is a little bit less than if we are part of the move that we were when price has just flipped bearish. If you think about it, we know that price has been pushing around 10, 12 pips during these previous hourly candles. If price has only pushed 3 pips and we've started to flip bearish, we know that we've got opportunity to continue downwards and take advantage of the range of the candle. However, if we've already pushed that far and we're looking to sell when we're all the way down here, we're hoping that this candle is going to be huge because we're going to want to enter and price to continue down to our 1 to 2 or a 1 to 3. So that's the main reason I wouldn't take that. Another reason I wouldn't take that is we are late into the hourly candle now, so I don't really take anything after sort of, I'd say half an hour, 40 minutes into the current hourly candle, just because we find that the momentum starts slowing down a little bit. I like to be part of that first move. So by the time we get triggered into this one, it'd be 7:51. At that point, we're waiting for the 8 a.m. candle to open, because what may happen is price may continue up and we may have a bullish candle at 8 o'clock and we'll be looking for buys instead of sells. So it just doesn't make much sense to be entering so late into the candle, especially when we've already had that move and the opportunity was up here. Now, I've had a couple of questions on patterns like this, like why haven't I taken this? And the reason is the shift for me is all the way up here. It just wasn't valid because it was so late in the candle. Price now is starting to push down. It's making lower lows and lower highs. I don't like trading lower lows and lower highs, even though we are looking to sell, and that is sort of the normal thing to do. I like price to clearly push up into one direction and then fail and break. Don't like price when it's like this. It's already started to push down. I want it to be involved all the way up here, because if we get in further down, we've already lost some of that range. And at this point, we are just making higher highs and higher lows. So I don't personally take trades based off that. I also don't take trades where price is moving sideways like this. Even if we did get a couple of higher highs and higher lows in here, it's just not as clear. Now, granted, price did continue down. It's just not an entry for me. But like I say, the main theory behind the trade is still there. Previous hourly candle is bearish. We're expecting the new hourly candle to continue bearish. We're just looking for an entry. And we can see that yesterday morning, we had 4 hours worth of bearish price action that we could have been taking advantage of. And one thing to consider is after we've had all of this bearish momentum, we have to think logically about how likely is it the price is going to continue down. I like to be part of the first 1 or 2, maybe 3 candles that we get after we've had 4 hours worth of bearish price action. Even though we have moved around this area, it's not like we're moving sideways. There's no reason why price may start pushing up until I'd say around here. I just much prefer to be part of that initial move, so that first 1 or 2 bearish candles, as opposed to be looking to sell all the way down here where we've already pushed bearish for 4 hours. Price has moved a lot in terms of range as well. So we've moved 50 pips, and after a 50 pip move, do we want to be looking for sells? I'm not sure. I don't personally. I much prefer to be part of these first couple of hourly candles, provided that we're not pushing into an area of rejection or we don't have an overextended candle. That's one thing I stay away from as well. So if we look at the average range of these candles that we were involved in, these are much nicer to trade as opposed to huge candles like this, where again, we'll be looking to sell after price has already pushed this much. It's much better to be part of the start of the move as opposed to trying to jump in a lot later. So after we've had this huge bearish candle, we've been pushing down that much for an hour, I wouldn't necessarily be looking to sell at that point. Now, while backtesting, I do trade every single hourly closed from 6 a.m. up until 4 p.m. just to give me as much data as possible on every single hour, and then I can use that data to decide when is best to trade based off what has been most profitable previously. Now, when I'm in the live markets, I'm not able to trade every single hourly candle just because I've got other things to be doing, and I also don't think it's the best idea to just sit at the markets all day. So what I tend to do is I tend to trade from 6 until 8, so I'll trade the 6 a.m. hourly candle close, the 7 a.m. hourly candle close, and the 8 a.m. hourly candle close. I then tend to step away from the markets for a bit, and then I come back at 12 p.m. UK time and trade 12 p.m, 1 p.m, 2 p.m, sometimes 3 p.m, depending on how much news there is, just because that works for me. Now, obviously what works for me may not work for you, but it just currently fits my lifestyle to be trading that way. So once I come back at 12 o'clock, there's no trade here for me because price is just making lower lows and lower highs. We want to see, like I've said, price start to make higher highs and higher lows, make a highest point, fail to break that highest point, and then break the low. And then we could enter something like this. But when price is just making lower lows and lower highs, I'm not looking to get into that because eventually price may reverse. And like I've said, I don't like to trade after hourly candles this big. I don't think there was any high impact news yesterday, but there just was a lot of volume in Great British Pound US dollar. So after we've had this bearish candle, I wouldn't be looking to sell. I'd come back at 1 o'clock and see how we've closed, and we can see that we've closed bullish. So when the 2 till 3 candle opens, I will be looking for a buy-in opportunity. Now, I remember seeing this, there wasn't anything at the time just because price started pushing up initially, it then came down, and then what's going to happen sometimes is we are looking for that shift where price has been making lower lows and lower highs. It then fails to break a low, comes up, makes a new higher low, and then we get that shift. So it'll be from this low point to a new higher low, breaking a high and then continuing upwards. And that's what we look to trade. However, sometimes price is going to do this. It's going to make lower lows and lower highs, fail to break this low, and then just shoot up. I suppose technically the next higher low would actually be all the way up here, but obviously we're not looking to trade like that. We want the shift to be much lower down here so we can get an entry when price is just flipping into our direction. By the time we get this higher low, it's all the way up here. That's just not a trading opportunity. The trading opportunity actually came on the next candle. So we can see that we closed bullish from 2 till 3. So we are looking to buy. Near the end of the previous candle, so the 2 till 3, we start making lower lows and lower highs. We make the lowest point of the candle, which is here. When the 3 o'clock candle opens, we fail to break below this low. We shift and then we are triggered into the trade. Now this one initially went into some drawdown. That wasn't the cleanest trade because we did have to sit in it for a while, but either way, we did get there. So if we look from a line chart perspective, lower lows and lower highs, lowest point of the candle, fail to break that low. The shift that we have is from there to there. So it is a little bit of a bigger stop loss with this one. This is why I definitely go for a 1 to 2. So this is a 7 pip stop loss, but I was happy to take this simply because I can see how much we are moving on Great British Pound US dollar. Price continues up, and then I personally wouldn't be looking to trade after 4 o'clock, especially if we've already taken 2 winners for the day. But this is another trading opportunity I just marked out. We closed bullish from 3 till 4. Obviously we were part of that move. Price then starts pushing down when the new hourly candle opens. Now it's really late in the candle, it's also late in the day. I'm just marking this out from a pattern point of view. We start to make lower lows and lower highs. We make the lowest point of the candle here, fail to break below that low. We shift to then get a new higher low, which is here. Once we break above that high, 6.5 pip stop loss. Price pushes up. This was a break-even trade. Price pushed up. We go break-even at 1.5, which you can see we do in a few minutes. And then price comes back down, stops us out at break even. So that is GU, that's the main pair that I trade. However, there is opportunity to trade this way on other pairs as well, simply because it is based on price action. So if we look again yesterday, but this time on gold, there wasn't any entries in the morning that I can remember. So if we go at 6 o'clock, you can see that from 5 till 6, we do have this bullish candle, so we'd be looking to buy. But from a 1 minute perspective, we are just moving so sideways. There's no lower lows, lower highs, and shift to work with here. There's just no trading opportunity. We really want to see that clear shift from one direction into another. We then close bearish from 6 till 7, so we would be looking for sells. So once we open at 7 o'clock, we would be looking for higher highs and higher lows for a shift. Now some people may potentially see this as the shift and look for a break of the low. This is at 7:30. We're quite high up the hourly candle at the time, so I suppose there is some room to continue down. Now sometimes you can put the stop loss above the shift, so if it's a nice clear pattern like this is a fine stop loss. However, if you want to be a bit safer, you could include this, but we do have to consider how big our stop losses are. Now this isn't a trade that I would take personally, just because for me, price is just moving sideways here. So even though we technically do get a new higher high, we then fail to break that high and we get that shift. I just don't like that. It isn't clear enough at all. Even though this worked out, that's just not a trade that I'd be taking personally. I much prefer to see what happened a little bit later in the morning, where we can clearly see that price is pushing up here. So I've closed bearish from 7 till 8. 8 o'clock candle has opened. We're 20 minutes in. Price starts pushing up, making its higher highs, higher lows. Failure to break this high. There's the shift. At the time of entry, the current hourly candle would be bearish. We're 40 minutes into the candle, so a little bit later. However, gold does tend to move a lot. So we break this low, triggered into this trade, and there's the 1 to 2. Now hopefully you can see the difference between this trade with the higher highs, higher lows, failure to break that high, comes down here to make a new low, which we can see more on the line chart. It comes back up to make a lower high, breaks below that low. We're bearish on the current hourly candle when we triggered into the trade, and then within 2 minutes price goes down for a 1 to 2. So hopefully you can see why I prefer that trade as opposed to this one over here, where price is just moving a bit too sideways. Again, a buy opportunity, just a little bit messy for me. Price isn't clearly making lower lows and lower highs. We do start to shift down. If we go over the line chart, we'll be able to see that more. Do make a new lower low, lower high, failure to break this low. This isn't a trade I'll be taking again. I just wanted to mark these out just to hopefully illustrate the point a little bit further. But what I do like about this one is the 9 till 10 candle has closed bullish, and we'd be entering this trade in the first minute of the new hourly candle. So price is only just pushing bullish while we're triggered into this trade, so it just makes it a little bit more likely that we may continue up. Got no areas to worry about on the hourly chart until I'd say around here. So we know that we've got room to push all the way up. So it's a potential buy trade. I just don't like it too much from a minute perspective, but we did start making lower lows, lower highs. There's the shift. It just looks a bit weird, so not something I'd take. And then another trade here on gold. Gold can be a little bit more messy, but we've closed bullish, previous hourly candle, 10 to 11. So when the 11 o'clock candle opens, we can see during the 10 to 11 candle, we did start making lower lows, lower highs. We make a low here, fail to break that low. Once we shift and we break the high, new hourly candle is bullish at the time. We triggered into that one, initially get into some drawdown, and then price does continue up. A little bit messy, but the idea is always the same, and that is why this strategy is applicable to all markets, just because it's based on price action, and price action happens across all markets and all time frames. So really hope you enjoyed the video. If you have any questions at all, please let me know in the comments. Thanks very much for watching.